Welcome back to our channel where we bring you the latest updates on the economy and financial news. Today we're discussing the latest report on inflation in April. The numbers show some interesting trends, so let's dive right in. Inflation edged slightly lower in April, which could have implications for the Federal Reserve's decision on interest rates. According to the Labor Department, the Consumer Price Index rose 4.9% in April compared to the previous year, down from March's 5% increase. Although there has been a decline from the peak of 9.1% in June 2022, inflation remains historically high. On a monthly basis, consumer prices rose by a seasonally adjusted 0.4% in April compared to a 0.1% gain in March. This increase was primarily driven by housing costs, which economists expect to cool down in the coming months. Additionally, gasoline and used car prices also saw a rise last month. This latest report makes it easier for the Federal Reserve to pause their rate increases, as it shows that price pressures are not worsening and might even be slowing down. The Fed has been aggressively raising rates for over a year to combat inflation and slow down economic activity. Their ultimate goal is to see inflation decline toward their target of 2%. The stock market had mixed reactions to this news. On Wednesday, the Dow Industrials edged lower, while the tech-heavy NASDAQ rose by 1%, and the S&P 500 saw a 0.45% increase. Bond yields moved lower as well, with the 10-year Treasury note falling to 3.438% from 3.520% on Tuesday. Apart from inflation, the Federal Reserve is also keeping a close eye on recent bank failures and their impact on lending conditions and economic activity. These factors won't immediately show up in broader measures of hiring and inflation, but they are crucial in assessing the overall economic situation. During their meeting last week, Fed officials approved raising their benchmark federal funds rate to a range between 5% and 5.25%, the highest level in 16 years. However, Fed Chair Jerome Powell mentioned that they are considering whether they might be done raising rates as they believe they are getting closer to their goals. Previously, officials were looking for clear signs of a slowdown to justify ending rate increases. But now, Mr. Powell indicated that the calculation could shift and they would need to see signs of stronger than expected growth, hiring, and inflation to continue raising rates. The Fed's rate hikes tighten financial conditions, leading to higher borrowing costs, lower stock prices, and a stronger dollar. While the report does indicate some positive signs for continued slowdown in price gains, there is still a risk that rates may need to remain high for a little longer than initially assumed. Economist Andrew Hunter from Capital Economics has noted this potential risk. Currently, investors are estimating a 14% chance that the Fed will raise rates at its next meeting, according to CME Group. This uncertainty reflects the cautious approach taken by investors and the market as they analyze the economic indicators. The report also sheds light on core prices, which exclude volatile food and energy items. Core prices rose 5.5% from a year earlier, showing a slightly slower increase than in March. Economists consider core prices to be a better predictor of future inflation. Core prices remain elevated due to persistently strong shelter costs. Changes in housing prices take time to show up in inflation data because of the lag in mortgage and rental contracts. If we exclude shelter, along with food and energy, prices rose by 3.7% in April from the previous year. Some Americans are adjusting their spending habits as prices continue to rise. Take the case of Ryan Flick, a Denver resident who works in tech sales. He used to eat fast food a couple of times a week, but as prices rose, he chose to cut back and make sandwiches at home to save money. This trend of cutting back on discretionary spending might provide relief to household budgets in the face of inflation. Inflation started to rise sharply in late 2020 as pandemic restrictions eased, and it remains well above 2019 levels. Initially, price pressures grew due to supply chain bottlenecks and high commodity prices, but those factors have significantly improved. However, sustained demand for workers among service providers and higher labor costs are supporting inflation. On the other hand, some companies are experiencing a fading of the significant pricing power they enjoyed in recent years. Early signs of a consumer pullback have led to stagnation in consumer spending, which is a primary driver of economic growth. A slowdown in business investment and a weak housing market, influenced by interest rates, have contributed to a broader economic cooling this year. To cope with high input costs, businesses like Nelson's Greenhouse in Clinton are implementing new strategies. They have decided to add a surcharge for customers who pay with credit cards instead of raising prices. Encouraging cash payments will help save on interchange fees. They have also cut back on offerings by shutting down the greenhouse over the winter to save on propane costs. That's all for today's update on the latest inflation report. We hope you found this information valuable. Don't forget to like and subscribe to our channel for more updates on the economy and financial news. Thanks for watching, and we'll see you next time.